down here at the river. Thought while I was fishing, or I just went fishing, thought I'd step over here into the shade real quick and talk through why we have financial accounting. So we talked a little bit about this last time. I'm going to expand on it a little bit more and also bring in a little bit of some of the economic theory behind it. So I'd like to pose a question before we get started. The question is, would companies provide financial statements without the regulatory requirement to do so? i.e., in the US, public companies are required to provide financial statements annually and then partially every quarter for investors to make decisions off of. Now, that requirement has been around since basically the 1934 Act from a continuing basis. The question is, would companies continue to do that even in the absence of the requirement to do so? So usually about half of my students would say they do, half would say they don't. I challenge them a little bit on that. So I would argue that they still would. And from a historical perspective, almost every public company before the requirement still issued financial statements to its investors. They weren't as consistent. The information was not quite as refined as it is now, almost 100 years later, but they still did so. As a matter of fact, I think about 85% of the companies, even before they had to, provided audited financial statements every year to their investors. So the idea of companies providing financial statements goes beyond just a regulatory requirement to do so or politicians thinking that this would be a good idea. It extends from the capital markets and allocation of capital decisions that are made apart from a regulation or from a government imposed perspective. So where this actually comes from, so this builds on this idea presented by Akerlof in his Nobel Prize winning paper, The Market for Lemons. And this idea that, so what he proposed was a market for lemons. He used used cars. I'll be discussing it primarily in the terms of companies or products. However, so what he basically argued and what he presented in this paper was that when quality is unobservable to buyers, when they enter a market, they are willing to pay basically the mid-range of the quality they expect or that they would anticipate in the market. So if you're buying a car or investing in a company and you would say, okay, well, some of these are good companies and some are bad companies, I'm gonna pick the middle ground, and that's what I'm willing to pay for, knowing that, well, there's a 50% chance it's bad and a 50% chance that it's good. Well, in that scenario, I'm underpaying if it's a good company, I'm overpaying if it's a bad company. This is just a two-company example, but it extends much more broadly than that. So the problem with that is what then happens is, well, the good companies, they either leave the market or they stop being good, or management starts absconding with more money or something like that, which makes them not good from a product standpoint. A company basically reduces the quality of the product that they're selling. And that then in turn, now I'm looking at products that are still bad products are still out there. And now the good products aren't there anymore. Now I have lower quality investments. So I, as a buyer, reduce the price I'm willing to pay yet again. And this leads to this giant cycle where buyers pay less, sellers provide less high quality, buyers then pay less, sellers provide less high quality. This spiral, often known as a death spiral, when it ends, there are no good products available in the market. Buyers weren't willing to buy bad products, and therefore the market evaporates. So the market goes away. There is no market because there is no ability for a high quality product to differentiate itself from a low quality product. So what we have here is that when quality is unobservable to buyers, that's what's called information asymmetry, which means there's a difference in information between what the quality observable to the seller and the quality observable to the buyer. And what that generates, the problem it causes, is what we refer to as adverse selection, which means you end up with a market where just because someone's in the market, you assume that it's low quality and you aren't interested in buying. So in a stock market or in a market where there's only bad companies willing to seek investors because the returns are so low, or my price I'm willing to pay is so low that only bad companies would go there, I wouldn't want to invest in any of them because they're all lousy. So the market would go away. Accounting comes in, it generally reduces information asymmetry. It allows buyers to ascertain the quality of the investment that they're getting. and it reduces the problem of adverse selection, or the chance that we end up with a market with nothing but bad products in it. So that's kind of how that all works out. So in general, it's referred to as the market for lemons. And accounting, or financial accounting, reduces information asymmetry by providing information about companies to investors, thereby reducing the problem of adverse selection. Now, it doesn't make it totally go away, even within the public company or public equity markets, but it does help to reduce it. So the two key terms, information asymmetry, just means that buyers, or in this case management, has better information than investors, and that can lead to adverse selection, which just means that the mere presence of a company offering its stock for sale implies that it's not really worth investing in anyway. So those are some key terms that you need to be aware of. And again, this brings us back to this idea of capital allocation. The objective of accounting, or what accounting is trying to do, is help investors allocate capital, i.e. between the good companies and the bad companies. Investors have giving investors the ability to identify a good company will help them allocate capital to good companies. Those companies will have the capital they need to succeed, continue to develop products, continue to innovate and grow, while bad companies, or poorly performing companies, will have trouble attracting capital, but that's okay because they're not providing a lot of value. They don't have a good product, they don't have a good management team. For whatever reason, they should be avoided. We don't want to give them more money just to waste. We want to give it to highly profitable companies. And accounting helps provide information in order to make that capital allocation decision. So the objective of financial reporting is to provide financial information about the reporting entity that's both useful to a wide variety of users. Now, we talked about a wide variety of users. Now, throughout this course, we'll primarily focus on investors. They are the primary user group, especially in the US, where investors are primarily restricted to public financial statements that are issued by the public companies. They don't have access to private information directly from management. Now, that's in contrast to some other capital providers like lenders or other creditors who do have access to private information. A lender can require a company to provide them all kinds of private information as a condition for giving them a loan. Investors don't have that option in the US, at least not in a public company. So the general purpose financial statements are used by any number of people. Investors, that means present investors, potential investors, all kinds of different investors, creditors, other or lenders. They're using these general purpose financial statements, and they're all making it in the capital allocation process. These are people who have capital who are looking for companies to put it into, whether it's loan capital or investment capital. They're still looking for the same thing or they're still looking for high quality investments for their capital. So what we do within accounting, we have an entity perspective. That just means that the company is distinct from its owners or investors or creditors or whatever. The company stands alone. It's not the same thing as management. It's not the same thing as the investors. It's a standalone entity with its own set of legal rights and whatnot. So we have the entity perspective, and then we're focusing on decision usefulness. The purpose of these financial statements is that they are useful in making a decision, the decision about allocation of capital. And what we're focused on is the ability, or ascertaining the ability of the company to generate net cash inflows in the future. That is, for one reason, why everything in financial statements is recorded back into a cash basis. That cash basis is because cash is what we're looking for from an investment. If I invest in a company, they need to be able to generate net cash inflows in the future. That's how I will recoup my investment. If they can't provide net positive cash flows, then they're not a good investment. I should try to avoid them. So that is how it's decision useful. A couple of things as we develop standards around this. So the capital providers are looking for information. That information needs to be relevant to their decision. It needs to be faithfully represented, and it needs to have some other attributes like comparability, both within company across years and across companies. It needs to be timely, understandable, verifiable. These are all attributes that we start looking for. To respond to this, the accounting profession has developed generally accepted accounting principles, or GAAP. Generally accepted accounting principles dictate to us basically, or tell us what is generally accepted in terms of how we account for something. How do we measure assets and bring them to cash? How are they reported? They're reported, well, for instance, we have balance sheets, income statements, equity statements, statement of cash flows. These are standardized statements, the preparation of which is dictated by generally accepted accounting principles, or GAAP. That's what we base this on. These standards are developed using a couple of key attributes. So, as I mentioned, relevance. The information contained in these statements needs to be relevant to the decision makers. Now, primarily we're focused on investors, but the broad idea is these are general purpose. So we can use this forever for multiple reasons. So relevance, it has to have predictive value, i.e. it needs to be able to predict future cash flows. Confirmatory value, tell me what has happened in the past. And generally, only things that are material are going to end up in these. They need to be faithfully represented, which means they need to be complete and have all the information necessary for investors to make decisions and make capital allocation decisions. They need to be neutral. I don't want management's bias or their overly rosy perspective of what the world may look like when they triple their sales in the next 3 months. That's very nice. Management thinks that. I don't want that baked into the set of financial statements. I want them to be neutral, not biased, especially by management. And it should go without saying, these need to be correct or free from error. Some other qualities we look for: comparability that I've talked about before. Verifiability really helps increase the validity or the perceived validity of these financial statements, which increases the amount of weight investors will put on them when they're making their decisions. They need to be timely, and obviously they need to be understandable to what you call a educated or reasonably informed investor. So those are some attributes we look at. Now, this accounting information, this forms just one piece of the broader information environment for entities. Entities have all kinds of ways information about them is disseminated into the market. Financial statements are just one piece. Now, the value of those lies in that it's grounded. It's interpretable across companies, across industries, across time, and it's understood. Like, there's a very formal set of standards, generally accepted accounting principles, that dictate how this is presented, which means it's comparable. It's usually been audited for public companies. So just the auditing of this helps ensure validity or that it's valid and can be relied on. So investors will place a lot of value in that, which gives accounting a very solid footing in providing information about economic entities to investors and other capital providers. However, it is not the only source of information out there. There's plenty of external information, whether that be industry groups or your own personal information or personal experience with a company or exposure to a company or your own research that doesn't involve financial statements. That's plenty of information about that out there. There's also other reporting that companies do. Management provides a lot of information beyond the financial statements. If you just picked up a 10K, which is filed for every public company with the SEC, if you opened up a 10K, you would actually find that most of them, the financial statements, are shorter than the rest of the information provided. Management provides extensive discussion and analysis, or what we call management's discussion analysis. MD&A in the financial statements is extensive. It has all kinds of information about what management's expecting and where they're focusing their efforts and how did they do and how does that relate to their past goals. Or they have strategic initiatives and what are those and where do they think their best market penetration is going to be in the future. Management provides lots of information through the 10K or management's discussion, through issuing forecasts of what their sales or revenue or net income is going to be. They issue press releases that talk about how they did for the quarter and how they expect to do for the next quarter. Like, this is all additional information, not part of the financial statements, that management provides, that other entities provide, that give us a full picture of the business. Accounting has a very solid place in that because of generally the reliability of the information provided, but it is by far not the only one. So with that kind of wraps up our discussion of the financial reporting environment, with a quick talk about kind of what roles does accounting provide in the economic atmosphere, what problems does it seek to solve, this problem of adverse selection. They do that by reducing information asymmetry between management and investors. And we talked briefly about the attributes of accounting. Now, the attributes, we'll be talking much more extensively about the attributes when we talk about conceptual framework probably next week. But we briefly touched on some of these attributes today, and then we kind of talked about some of the objectives of financial reporting. So with that, I will wrap off. God bless, have a great day, and hopefully you enjoyed the video.